Good afternoon, everyone. This is Mark Robertson with the 506 Investor Group. Today we have another in our series of sponsor webinars. Today I'm proud to present the Thurston Group, and they're going to go over their newest fund. And we have Dan Davis and Dana Hayes with us. And as usual, the first 30 minutes or so will be a slide presentation, and then the last half will go over questions. And so if you have any questions during their presentation, please type those in the chat, and I'll ask those at the end. But for now, welcome, guys. How are you guys? I think you're muted. Dan, can you hear me? Dan, I think you're muted. Dana is too. Dan or Dan, can you guys hear me? Must have muted a caller. I'll unmute all callers.
Mark, I can hear you.
Yeah, I think now I should be good. It says unmuted on my end. Can you hear me, Mark?
I can. Sorry about that. We will start over. Welcome, guys. This is Dan and Dana from Thurston Group.
Thanks, Mark. Appreciate the time today, and it's nice meeting everyone virtually. Getting used to these Zoom calls, that's for sure. But we're excited to be able to go over this presentation. I'll try to limit it to 30 minutes. I know we put a lot into some of these slides, but I think it's important to get to the Q&A. Let's move on to the next one. So first I'll go over Thurston Group, and then I'll talk a little bit about the dental industry. Moving on to our business, Gen 4, which is a general dental service organization that we're excited to share with you. And then we'll go over our transaction. So a little bit about us here at Thurston. We were founded in 1986 he's still our chairman and CEO, Pat Haynes. So we've been around 30 years. In the beginning, invested as an institutional investor to some wealthy family offices in the Chicago area, and then eventually evolved to what's considered private equity today. So investing money in a company, helping it out operationally, and then having a value and an exit for it. So during the 30-year period, invested in a couple of different market segments, telecommunications, billing services, and then when I joined the firm in 2012, really started to concentrate on the dental service organization industry. And we'll go over the reasons and the merits that we really like the dental industry and why we decided to move forward with it. But we love here, part of our thesis here is we love partnering with entrepreneurial doctors and entrepreneurial businessmen who haven't had institutional money yet. We look for reoccurring revenue, strong profitability, but I think more important than everything is having a strong cultural alignment and cohesion with our partners and an appetite to grow. By background, we're mostly a buy and build strategy, but we have had access and the ability to grow via de novos as well. So we like to have that double threat. And finally, our operational focus I think is what really differentiates ourselves from a lot of our peers out there, because we like to get in investments at a lower level, roll up our sleeves, and come in as interim management team as we build to scale, which allows us and our investors and our partners, we are able to get in at a lower multiple and not have to go through investment banking. So a lot of times we consider ourselves like real estate developers, having a blank slate having a strong vision on an industry and then executing on it, which shows, we have a strong track record. We pulled up here just from 2000 over a 3.5 times multiple on invested cash. Let's move on to the next one. So here's just a timeline to take a look at it. So you can look at 1993 to around 2012 was different market segments. I came in 2012. A little background on me. I'm from Chicago originally. I'm a managing director here now. Did my undergrad at the Naval Academy, got commissioned in the Marine Corps, did 5 years of active duty, got out in 2007 where I came back to Chicago to go to business school at Booth. And it was around that time I met Pat Haynes. So Pat has a similar background where he was in the Marine Corps as well. He's a helicopter pilot. I was an infantry officer, so same branch of the military, but a little bit different jobs. And at that point is when he decided he wanted to get into healthcare multi-unit sites. So we were looking at the usual suspects, dermatology, ophthalmology, veterinarian, but really like the dental market, which we have a couple of slides and some graphics to show you. So once we got into it, we really rolled up our sleeves and put all of our effort in there. And then from 2013 to where we are today, we've created 6 dental platforms, again, all through our spheres of influence, not going through an investment banking process to get to where we are today, and have some significant returns on 2 of them as well. Next slide. So here's a picture of the team. You have Pat, as I was saying, chairman, CEO, prolific investor, has been doing this for some time. He comes into the majority of our companies as executive or chairman. In some cases, as we're building up the team, going back to our operational focus, he'll come in as interim CEO. Myself gave my background. Pat and I did all of our dental deals together. We have 3 vice presidents. Jackson Jenkins, who's been with me for a couple of years, graduated from University of Chicago, did his investment banking at Raymond James, and he helps with South Georgia US Endo. Dana Hayes, who's with me here today. I'll let Dana say a couple of words about himself.
Hey everyone, nice to meet you over the phone. I appreciate you taking the time. Like Dan said, my name is Dana Hayes. I'm a vice president at Thurston Group. From Chicago originally, did my undergrad at DePauw University, small school in Greencastle, Indiana. Played on the golf team there, and post-grad joined Kane Brothers, healthcare-focused investment bank, one of the most active healthcare middle market banks out there. And spent about 3 years there, and then fortunately joined Dan and the team about 1.5 years ago, and work, on South Georgia, US Endo, in addition to a few other portfolio companies, evaluating, diligencing, and working operationally with teams.
Thanks, Dana. And then we have Sam Ticker, who's also one of our VPs. I've actually been working with Sam for about 3 years. He used to be part of a financial consulting group that I utilized. And then we were lucky enough to have him join the team last year as well. He's really focused when we do our due diligence on the pre-operational due diligence, getting us to our scalable infrastructure and post-transition executing on the 100-day planning. A lot of times we'll go through this as well, setting up the treasury management, the infrastructure to actually build a company. Next slide. So the dental industry, next slide. So as I was saying, we were looking at dermatology, ophthalmology, veterinarian. Love the dental industry for a couple of these reasons. One, the size. So we really want to get into something that has a large market size. It's $135 billion and it's growing. I see some numbers where it's getting close to that $150 billion mark. Keep on going to the next slide. Dental school graduates, it's increasing. We've got aging population. The big part of this too, when we started this in 2012, was the dynamics of the industry was changing. And I know that we have some dentists, Mark was telling me, that are joining us. So, what we saw back in 2012 as well is that dentists were coming out of school with a lot of debt, approximately $250,000 just in dental school. And then you put on top of that, if they did some undergrad, any type of personal loans, it could be in excess of $500,000. So what we saw was the old way of doing business wasn't there anymore, where an associate doc would get out of school, go to a retiring doc, get a loan to buy the practice and then move on, they were no longer financeable. So that's when these DSOs started to form and start to take shape. Even though I'm doing this since 2012, sometimes I feel it's a competitive market, but at the end of the day, what I'm always happy and I'm sometimes surprised about, when we started in 2012, about 12% of the market was with private equity. Where we stand today, it's around 16 to 17%, which once again, it just solidifies there's a lot of growth still to be had. There's a lot of white space in this market. So it's not oversaturated, not overcompetitive. You just have to find the right properties and who you can align yourself with to grow. And this really shows it too, this DSO landscape. You could take a look at some of these other healthcare sectors, starting off with dialysis with DaVita, that's very well known, all the way to dental. There's a lot of open non-DSO space out there with a fragmented population. So one or two dentists really looking for potential exit opportunities, partnerships, being proactive to just not retirement. And I think, if anything, over the course of the last year, the pandemic has really solidified for a lot of our portfolio companies and for Gen 4 that dentists feel like they wish they were part of a group a lot of times, so they didn't have to go through this pandemic by themselves. Next slide. So for some that don't know, just a little background, what is a DSO? So a DSO is a dental service organization. The way it's set up, if you see that red box right there, that would be General Dental Partners. So that's our Delaware limited liability company. And the way a legal structure would work is we would put in our money, Thurston and our co-investors, into that holding company, the red box. And then our doctors and all of our partnerships roll in equity into our deal. So a differentiator that you might see with Thurston that's different from some of the other opportunities out there is that our doctors, in the true sense of the word, are partners with us, and we have them in the same class of shares that we invest in roll in to the bigger organization. And we think it's just a better way of doing business. We're aligning incentives correctly, and at the end of the day, we're all pulling from the same org. Below the box, you'll see dental practice A, B, and C. For visuals, we put it below. It really should be next to each other like this because it's a management service organization. So the DSO, and we put an agreement with the clinical entities that are owned by a doctor. So we usually do asset purchase agreements. Doctors own the taxi IN. And at the end of the day, we're charging a fee for that right side, those back office operations. So when we put together our dental service organization, we're helping provide finance and accounting support, marketing, quality insurance when we talk about compliance. If we're building up de novos, so a de novo is building a practice from the ground up and managing it, having M&As or mergers and acquisitions is a centralized function, and alleviate a lot of that pain and burden that a lot of doctors don't want to do, and that's doing payroll, human resources, et cetera. So that's the back office at the end of the day and how this works legally, the structure. Went into this, why we like it. We love the long-term fundamentals. We think it hasn't changed. So still it's a large market. We're in network and private pay. So this opportunity has less than 1% Medicaid. So I'm not worried about the Medicaid risk. Large fragmented market. It's well capitalized with the way we're putting it together. And we have a large scale to really fill in a void in the way our opportunities here, especially in the southwestern region. Next slide. I thought this would be important as we begin to talk about it. What drives value? So how do we start off, at $2 to $5 million in EBITDA, and then grow it to a post-corporate EBITDA of $25 million? And how do we start off? We're buying in at 5.5 to 6 times multiple. How are we able to bring it to the 12 to 14 times multiple? Something that we've done in the past. And these are the drivers. So it's two things I think about. First thing is always partnering with clinical excellence. So our back office team, none of us are going to be going to dental school, so we have to rely on good partners and good dental partners. So that's key number one in any of the businesses Thurston has worked with, and specifically with Gen 4 as well. When we partner with dentists, we're not looking to look over their shoulder. They have clinical autonomy, and that's key for us. The second part of that is a lot of these other things that you'll see here is the value is created when we build that back office. So as we start growing acquisitions, we start off with 5, we go to 15, we go to 30. We have to do that in a seamless way where the engine doesn't break down because we're a buy and build strategy. So we do that the correct way. We ramp it up to be able to create that value. So you have clinical excellence, you have a strong premier executive team put together and ready for expansion. Next slide. Once again, I thought it'd be interesting for you guys as investors to take a look at some of these other transactions that were before us. Enterprise values can range from 30 all the way up to 218. But I would really concentrate on that post-corporate EBITDA. When I talk about practice EBITDA and post-corporate is meaning the management team. So that's the expenses that go with that. And what you'll see is, if you get to scale, you should be around the median average is around that 12 times multiple. And that's always our goal as we build up teams, as we build up companies to get it to that, our goal in a 5-year period, that $25 million in EBITDA. And then we have, good valuation, good arbitrage from where we started. Do that with our consolidated playbook. So with all of our companies, it's all about strategy planning, making sure we know what strategy we're going with. If it's mergers and acquisitions, if it's de novos, how are we going to grow it organically? And then the operation. So from day one, for Gen 4 as an example, we're in due diligence. Well, I'll show you the process update where we're at. But I've been working right now already on our KPIs, our reporting, how we're going to start centralizing our operational playbook of treasury management, human resources, how we're going to put that all together and match that up with the financials. These are things that we do prior to closing, that we take on the risk of funding to make sure that when we have a transaction and we hit the ground running, we're able to start implementing on our plan. Some of the key partners that we use to do this. So this is a repeatable, scalable method. So this is not the first time we're using this. This is what we've done on our last 4 dental partnerships. For our accounting, finance, operations, our IT support, so doing a deep dive, making sure we have good cyber attacks, cybersecurity, and there has been with Element 78. So they're a Chicago-based firm, and they'll help us with all these different companies that we have, put them all on a single financing operational construct, while at the same time doing the valuation of our IT, making sure it's up to where it needs to be, or are we going to have to invest in IT infrastructure going forward. PYA, that's very important. This is our healthcare compliance. So one thing we all take very seriously, it's one of the reasons why we partner with the best clinical people, is we don't want to have worries about our compliance and billing and coding issues. So during our due diligence and also post due diligence and post transaction, every 8 to 12 months, we'll bring in PIA, and they'll come in and do some billing and coding reviews to make sure that we're doing things the correct way. Because we build so fast, we don't want anything falling off, especially when it comes to compliance and patient care. Insurance is with Lockton. We use them. They help us consolidate any of our business and property insurance along with healthcare. A lot of times the practices that we're partnering with didn't give healthcare benefits to their employees, so that's something that we do too. We just make sure that we have that centralized the correct way. Insurance, fee-for-service analysis, this is really important as well. We've engaged 5 Lakes. They'll come in and take a deep dive look at each one of our practices, looking at the employers around the radius of that practice, seeing what insurance companies they take, what's their fee schedule, and then it's an analysis and a strategy session with me of where's the low-hanging fruit and what we could implement. A lot of times with some of these offices, they haven't touched their fees in 4 or 5 years, so that's pretty easy. But it's the fee optimization that's where we really see some pickup. It's a little bit more time intensive as far as looking at the third-party administrators along with the insurance companies to get to where we need to be. Finally, we've worked with Korn Ferry and our executive search. As we continue to ramp up and build up the team, they're always looking out for us for strong executives that we can add. Some group studies that we've used. So Smile Doctors, this was the first ever orthodontics platform. So there was no other, there wasn't a pediatric dental that's funneled in kids. There wasn't a general dentist. It was purely orthodontics. We started that in September of 2015, 7 docs, 7 locations, doing around 20 million in revenue, 6 million in EBITDA. And through a disciplined approach and finding other like-minded doctors, we were able to grow that in a 2-year period very significantly to around $35 million in EBITDA. Had a nice exit for our partners, over 4.5 times cash on cash in that short period of time. U.S. Oral Surgery Management is an oral surgery group. We started that in November of 17. Once again, started off with around 40 million, 5 in EBITDA. Grew that significantly in our buy and build strategy. We're around 180 at the end of last year, 37 in EBITDA, and that's taken into account, COVID. So great growth even during the COVID months. South Georgia, this is a general dental group. Started off with approximately 6 docs, 3 locations. That EBITDA is a little bit higher actually than what it really was. We actually started at $500,000, so very low starting point. However, we were partnering with a great chief clinical officer by the name of Dr. Zach Bentley, and he had a great game plan of how he wanted to grow in these non-urban battlefields where there was a lot of demand, but very low supply of doctors. Through that, we're around 31 million, 7 million in EBITDA, but we have another 3 million in EBITDA that's in our pipeline that's going to be under LOI shortly. Finally, U.S. Endodontics Partners, started that in December of 18, started off at around 2 million in EBITDA. We've grown that also significantly, buy and build strategy, 94 docs now, 47 locations, 22 million in EBITDA. We actually have another 6 million under LOI. Out of all these 4 practices, what they all have in common is very strong clinicians, very strong doctors. We handle the back office, but we really do rely on our doctors to really be evangelists and help us grow. And that's the partnership that we like to take, and that's what we're going to do with Gen 4. All right, moving on to business overview. So Gen 4, so the reason why I was excited about this opportunity is because of the leaders. I want to go to the next page real fast, and then we'll go back. So the chief executive officer is Lamont Jensen, and his chief clinical officer is Dr. Mitch Ellingson. So I've known Lamont for a little bit of time. We actually served in the Marine Corps together. We did a deployment together. He ended up going to business school in Chicago too. He was a little bit ahead of me, and then worked for McKinsey, the consulting group, and then eventually found himself at Spear Education, which is a large private equity-backed company by Linden. When he was at Spears, he was organizing and heading up the consulting services, working with doctors across the nation how to better improve their practices and get them more operationally efficient. That's where he met Dr. Mitch Ellingson, who's our chief clinical officer. Same thing, he's been in the Arizona market for over 20 years. He started working at Spear. He actually developed the practice analytics tool that they use to help doctors become more efficient. And that combination together, when they decided to invest in SunWest, was really exciting to me for a couple of reasons. One, it's all about the quality. So I knew Mitch, when I started spending some time with him, had great clinical quality with his doctors, and he was really able to understand the efficiencies and how to manage through KPIs, how to better make dental offices. And Lamont, there's not a lot of strong bench strength in the dental market, so he was a very strong CEO that's going to be able to lead us and use scale of economies, not at the office level, but he's going to be able to do that with the regional operators by implementing the strategy that they put together. Move back, please. So what we did is we put together a group. So if you take a look at the bottom right, that's what I consider our platform business. So it's 5 different group practices that we're going to put together that will be our clinical entity. That's going to be the starting point for Gen 4 Dental. It's doing approximately 20 million in revenue, 4 million in EBITDA, 15 locations, 22 docs. Primarily in Arizona in the Phoenix market and also in Salt Lake City, Utah. This is going to be our strategy where we're building up to, and we're going to continue to expand into these 2 markets and going into Colorado. That's going to be our phase 1 build for the next year, year and a half. When we started taking a look at these, I was happy with the size of it. I was happy with the EBITDA at the practice level, but I was even more excited once we started digging deeper into it, seeing organic growth. The way I provide value is making sure if we get it at 4 million, that I'm going to be able to increase that organically too. And that's through same store sales. And working with Lamont and Mitch, there's a lot of low hanging fruit that we're able to do with our affiliated practices. And to be clear, we don't brand anything. You know, if it's branded in that area, that's how it goes, but everyone keeps their same identity. And that's what's going to differentiate us as a DSO. You know, we believe that you want to have the doctors run the offices, the clinical autonomy, and let the back office do what they do best, and that's payroll, that's centralizing accounts payable, scheduling. You know, we went to a conference a couple of years ago in Texas, in Dallas, and it was the Dykema conference. It's a large law firm that deals specifically in dental. And they did a good job explaining the different phases and evolution of the DSO market, starting off where, you know, back in 2010 and 11, when we first started as well, where people would invest in dental because they liked the market, but they kept a lot of the power and the information at the board meetings and at the office, the executive level. And then it started to change and evolve as time went on. And that's where we're at today. That's why the company's called Gen 4. It's about empowering the employees, making it so it's not just a job for them, it's a career. And it's through our practice analytics and our software and the technology that they're able to actually control their destiny at the offices and really help grow and maintain what they put together. Take a look at footprints. In general dentistry, we like strong concentrations. We did some research in both of the states. I'll let Dana talk a little bit about, you know, what we saw in Arizona, what we saw in Utah as our starting point.
Yeah, so I think broadly what drew us to these couple states were just the overall growth that's occurring. You know, people are flocking, they're leaving, you know, New York, Chicago, larger cities, and flocking to Utah and Arizona, you know, as you can see with the 3rd and 4th highest rate of growth in the nation. To back that up, there's strong GDP growth and employment growth in both areas as the population continues to move there. I think Utah specifically too, you know, that they've been under-penetrated from a DSO perspective. They have about 4% of their dentists are part of dental service organizations. And so we see significant opportunity to really expand our presence in that market, partnering with strong clinicians that are well-respected in the industry with Rock Hotel Dental. And they have an immediate pipeline of people that want to join the practice. And so we see, you know, a lot of opportunity in Utah specifically to build that out, you know, quickly. In addition to, you know, our 4 groups that are in the Arizona market, you know, they have countless other industry contacts and friends in the industry that see this as a differentiated model to join compared to some of the other competitors out there in that Gen 4 kind of realm. Yeah.
We know Arizona has a strong concentration with DSOs, but at the same time, they're better educated. So as we started really narrowing down and going out there trying to find the best doctors to join our group, we actually saw that it was, in some cases, they got it faster than in some other areas that haven't been hit with DSOs. So they knew what they saw, they knew some of their previous conversations, what they liked and what they didn't like. And we have, you know, there's a difference with ours. You know, one is when people invest with us, they're investing the same class of share in that holding company. The Thurston money's coming in and there are investors. And some of the DSOs that are out there, it's a profit sharing. So it's the practice that they sell that they're participating in. I want them to participate the same level that we are across the board. Clinical autonomy too. You know, we have referrals. I have, 6 other platforms that they can call up and they can, test the water saying, how was it to work with Thurston pre-LOI, during the LOI, letter of intent, and after? Is it the way they said it was going to happen? So we have strong references too. So when they're working with us, they know it's just not us trying to get a sale, it's us trying to have a strong partnership. So starting at this point, doing a back and fill, we're already talking to, you'll see the pipeline in each one of these states, continuing to do a back and fill where I get strong EBITDA, hopefully 10 to 15 million in each state before we start moving on. So SunWest, what you'll see on this slide is our overview. The red ones are the other practices under LOI. The blue is where the SunWest, the 9 practices are at in this location. So low Medicaid, they have less than 1% Medicaid in their office. Hygiene, so why is hygiene important? So hygiene is how these patients will come in, every 6 to 12 months. When we're doing our initial due diligence, we are able to gather information to understand what is the active patient of all these offices. And when I think about active patients, the way we define it here, it's a patient that comes in once every 18 months. We obviously want it more than that, but that's what we consider an active patient, someone who's come in once every 18 months. So when we look at all these offices, all of them that we have under LOI, they have very strong active patients. When I see 15% hygiene, my goal is to get it to 25%. The way we get it to 25% or higher is just by educating the staff and using some of the tools that Lamont and Mitch have started to in 2019 and how they've decided to increase it. What we want to be able to do is make sure patients are not going out the back door. And what I mean by that is someone comes in for an appointment. Before they leave, we want to make sure that that appointment is set for the next time they come in. We also want to be able to work with it and somewhat data mining exercise. When we're looking at our hygiene schedule, when we're looking at schedules in general, if we're having Mrs. Smith come in on Monday, if there's any openings, we're then diving in to see if there's any relative or any type of association that we can also fill it in with. So we're constantly being proactive, looking at a week out, 2 weeks out, making sure that we hit our scheduling. SunWest is doing $8 million in revenue, approximately $1.8 million in EBITDA. We think this is a lot of low-hanging fruit. So again, with my initial conversation, I have to see some organic growth, and I do see it with SunWest as well. Biltmore Samit, this guy he's a great dentist. Worked extremely hard during the COVID period. He's doing $1.5 million in revenue, $375,000 in EBITDA, no Medicaid. He does a little bit more comprehensive dental care, and he's definitely going to be able to increase the EBITDA. We're even thinking about expanding this office depending on the patient flow. Rock Hotel, so this is our Utah group. So they're doing $3.5 million in revenue, $700,000 in EBITDA. When we did a look at their active patients and started visiting with them, they had over 8,000. They have a very large office because there's the 4 docs. They have 13 operatories. But what we saw most important about this group is that there was expansion to actually move into another location. And that keep them both open for 4 days a week. So the more we're digging in and looking at this group, they're profitable, strong now, but we do think with some extra work, we're actually going to be able to open up a second location and then have the doctors go 3 and 3 and really increase this to make this a $5 million practice. Pete Codell, talked to Dana, mentioned Dr. Shanahan. He's going to be one of our evangelists. He's an ambassador. Bringing him on has been a really strong move for our acquisitions and our partnerships going forward. He's doing $5.4 million, around $960,000 in EBITDA. But what's really interesting with him is he's a Pied Piper. He gets it. He wants to continue growing the company. So right now he's put on another 5 potential partnerships that we're doing due diligence on that want to join. And it's all within this Phoenix, Arizona market. So really growing that concentration. Dr. Cavendish, great guy, strong doctor who, shares the same type of culture that we want to have throughout all of our practices. has been a little bit limited, and he understands that with $1 million and $210,000 in EBITDA. But once again, wants to partner because of the reputation of Dr. Mitch and Lamont, and looking forward to growing the practice as well. So getting a little bit past the half-hour mark, so I'll continue moving through this so I can answer questions. But these are some of the differentiated practice improvements. Is want to continue the established culture. Part of that is creating a clinical advisory board. It's once again something that Thurston has done across all of our practices. It's a great way to be collegial with our doctors, and what we've realized across all of our practices is doctors love working with other doctors and sharing the best ways to treat patients and how to continue. And we saw that more than ever during the pandemic when we were getting PPE for our doctors, when we were figuring out the best ways safely to take care of our patients. We invest in the robust plans and coaching. That's not just with the technology, with the practice analytics. That's also other consulting groups that we use to make sure our office managers, once again, are not thinking this as just a 9-to-5, but really a career. The metrics and the KPIs, it's something that helps them reach goals. We're not looking over their shoulder with clinical autonomy, but at the same time, we want to provide the data. We want to empower them to hit where they want to be at. Yeah, next slide. This goes into some of our hygiene growth plans, clinical doctor support. A lot of the progress that we want to do is just make sure that we're frequent touches on a monthly basis and helping out with any type of improvement strategy that we originally talked about when we first partnered up. Here is just some of the practice analytics and the way they look at it on a discovery basis and some of the components of how they continue their growth plan. It's always important when we're able to give them the tools, they also got to be able to match up and continue to track progress on that monthly basis. So we work together on that. Next slide. Some operating infrastructure. Talked about doctor recruitment. So that's something that I've been working on with the team with Dr. Mitch, making sure as we grow and as we expand to continue to bring on associates. We have different strategies as well. So, you know, a good question that a lot of people ask is that the partners at Roland Equity have ownership. How do you do it with the associate docs because they don't have the cash? So what we put together, it's called a pathway to partnership. This pathway to partnership is essentially a promissory note or a loan that we have with our associate doctors that it's based with Gen 4. It gives them an opportunity without losing any type of current income in the beginning for the first 2 to 3 years to actually earn Class A shares, the same shares that we have and you have and the doctors have in Gen 4 without any type of risk of putting money up for that. Marketing and patient experience, regulatory and compliance we talked about with PIA, continuing to build the acquisition pipeline. The biggest part as we grow and the success that we've seen in the past is if you're going to build and do a buy and build in this manner, you have to make sure you have the infrastructure to be able to support that. So that's what we're constantly working on in the beginning. I think we hit on a lot of this already as far as the doctor additions. Talking about the M&A plan. So phase 1, as I was discussing, is going to be a focus in the Southwest region, starting off Arizona, Utah, and then Colorado. Phase 2 is, we know just from our, Lamont and Mitch have worked with over 700 doctors across the U.S. So there's a strong pipeline, and when people are hearing about this, they're very interested and want to explore an opportunity with us. However, we're going to stick with our discipline. We're going to stay in the Southwest region. Once we get to scale of around 15 million, we're going to start to be able to push out and expand into other territories as long as we see that there's a path to back and fill of that. So these are actually executable adjacent markets and what we're looking at as far as EBITDA and revenue. So you can see just with the Arizona market, we're in current discussions in various stages of diligence with over 80 million in revenue and 8 million in EBITDA. Same thing with Utah, 8 million in revenue, 1.6 in EBITDA, in Colorado, close to 12 million in revenue and 2.3 million in EBITDA. We've put a little halt on continuing these discussions because part of our strategy too is once we fund and close, when I put out an LOI with the team and our team puts out that letter of intent, I want to be able to close within 45 to 60 days. That's a reputational issue. I want to make sure that the doctors are not hung off, lying out there with letters of intent for 90 to 120 days. It's a very stressful time for people in this situation. It's something that they built from the ground up. It's something that's put their kids through school, bought their first house. I'm very aware of how close they are to these practices. So we try to make it so there's no disruption as possible. And I also don't want to keep having a letter of intent and legal due diligence hanging on their head. So I anticipate this pipeline to grow once we start really pushing with our M&A team.
And what prices are we paying for? Is it a multiple of EBITDA or is it on revenue? What's the range on those that are under LOI?
EBITDA. Yeah, it's always a multiple of EBITDA. Let's push over to where we're getting it for. So here's the base business. Our range is between 4.7 and 5.8 times multiple. As we, this is the starting point. And when I look at these multiples, I'm not putting into efficiencies with supplies or, a lot of times what you'll see in EBITDA multiples, they look low like this, but it's also putting in post-closing efficiencies, meaning when they're under my umbrella, I know they're doing, of their supply costs, it's 8% of revenue. I'm going to take that down to 5. I don't do that. I like to be conservative because I'm very cautious with my debt and leverage. So I keep everything the same. What I do add back is one-time or non-recurring expenses. So for example, if for some reason on their income statement, they bought, a printer or whatever the case, a large piece of equipment that I know it's a one-time expense or something that's non-reoccurring. The only other thing I really reset when I'm doing my EBITDA calculation is their compensation. Our doctors are compensated on net collections between 32 to 35%. Besides that, I do no other financial engineering. So coming in at a blended multiple of around 5.5, I feel good about that, especially as we were discussing. I think there's some expansion opportunities for organic growth. And then you saw as we grow and get to our model of 5 years, when we get to that $25 million post-corporate EBITDA, those multiples should be double digits.
But the dentists you're talking to, they're receptive to 5.5.
That's right. Because what's really important with our dentists is that they believe in the equity story, meaning the equity they roll in is usually between 20 and 30% into Gen 4. That's what they don't think that's a nice to have. They believe in what they're doing. So they're looking at it as their first bite of the apple, and they're interested in continuing to grow this, for the next 3 to 5 years, so they can get to another equity value and then do it again. Our average age is probably around 46 to 48 years old with our dentists. So they're really bought in on the ability to grow alongside us.
So they're cashing out 60% and keeping 40% or so in the business. Is that fair?
It's usually between 20 to 30% rollover.
Yeah.
So for instance, if we buy something at $1 million, 70% is cash, cap gains, 30% tax deferred roll into the entire Gen 4, the holding company, not just in their practice.
Gotcha.
Yeah, and so you'll see on this page here, first column is purchase price, cash at close in aggregate. I think they're cashing out about 67% and rolling 33%, all within, kind of those bands that Dan talked about on individualized practice level.
And is that what keeps them from bailing after a year or two and starting their own another practice?
So when we put together, so there's 2 agreements. There's an asset purchase agreement, and then they'll have an employment agreement. The asset purchase agreement, from the time they sign that, there's a 5-year non-compete, and it's usually a radius around their locations between 10, 15, 20 miles. And then there's a non-solicit, meaning they can't solicit other employees, they can't bring the patient records with them. And that's usually a 3-year period.
And is that enforceable for 5 years? I mean, in general, I've read that, more than 1 or 2 years, it's tough to make a non-compete enforceable. Is that your experience?
Yeah, I think it could go to arbitration, and they could probably open up. So that's why I put the non-solicit in there too.
Yep.
In all honesty, I'm not really concerned about the non-compete. I'd be more concerned about a doctor bringing a hygienist with them, or a dental assistant, or being able to bring the patients. That's going to be disruptive to the practice. But for a doctor to leave and go across the street, put in the investment, and then try to compete, there's risk to that. But I see more risk, and that's why you put in the non-solicit.
Has that been an issue at all in other funds or other investments in the past?
No, I mean, luckily we haven't had major issues with our doctors, and the retention's been high.
So what percentage is retention, ballpark?
Endo, out of 88 doctors, I think right now, we had one independent contractor leave in Texas. U.S. oral surgery, off the top of my head, I can't think of any of our doctors that have left. South Georgia Dental, we had, I believe it's 3 doctors that they left because they moved.
And how disruptive was that to the revenue stream, or did you just bring in new docs?
That's part of the geographic. So with general dentistry, that's why we have geographic concentration. So if we do have someone leave like that, I'm able to fill it in. So all within that Phoenix area, if one of those docs leaves, we'll have a contingency plan for that. Same thing in Utah. We're dealing with 4 docs right there, so it's not a one doctor practice. In the specialty market, I'm not as, all those practices are usually 2 to 3 docs.
Yep. All right. That's the question. Is there still more presentation, or?
Yeah, I'll be fast.
Right.
So page 37. Go back one. 37. Sorry, guys. We'll pull it back up.
There we go.
Term sheet. So it's going to be a single purpose LLC. We have a preferred return of 8%. Our carry is going to be 30. Once you get your PIK and your principal back, we'll share with the 31% maintenance fee. This is assuming, and I was talking before, Mark, $3 million, if we can consolidate $3 million. I might have the opportunity to go up to $5 million. So we're just working with a couple of different potential partners with this. But this is the way we were originally looking at it, if we were able to get to a $3 million investment. No questions with that. Just want to show you the process update. So this is just what we do basically for all of our deals. So we have a quality of earnings done. I don't care if it's $1 million or $500,000 practice. Cherry Becker does our quality of earnings. Lockton does our insurance. We do operational IT diligence. We look at the real estate to make sure that we have a fair market value. Our lawyers are Winston, and then we do background checks with Check Fund. So this is the due diligence that we do for every single acquisition before they join us. Want to talk about the projection?
Yeah. So like Dan was saying, we're starting off around 20 million in total revenue, about 4 million in EBITDA, and we look to grow that to that 25 million in post-corporate EBITDA over a 5-year period. So we put together, a 5-year projection model as part of our diligence and kind of model vetting and seeing where the organic growth levers are, as well as acquisitions that'll, lead to this strong growth. We go from 5 practices in 2020 to 31 through acquisitions. And, we're pretty conservative with our leverage levels, and the doctors rolling equity over allows us to do that. And you see, with the terms with our lender, we're in the 3s pretty consistently.
Yeah, so a couple of items on this. So 25 is our goal. We try to get to that $25 million post-corporate EBITDA. I like that. We have good experience with that. The reason why is we have a lot of different potential exit opportunities. Other larger healthcare-focused private equity groups, we know that's where they like to start, between that 25 or between that 20 to $30 million in post-corporate EBITDA. So we can have a nice, process with potential 6 to 7 partners. We have grown. So, for instance, we're on a pro forma basis, we're over 40 million in EBITDA, Smile Doctors, and it gets smaller. So you have less private equity groups that start off at that level. So we like where we get in at. We like the arbitrage growing into that 25 post-corporate. We think there's a lot of good partnerships that we can have in that 3 to 5 year period. Going back to Dana's point too, we do not like a lot of leverage. And I think the reason why all of our portfolio, our dental and all of our portfolios did really well even during the pandemic because we were never over leveraged. We have the ability to go up to 5, but we always stay around that 3.5, and we ramp up as we do that too. So with this investment, we're at 2.5, but we're already keeping a good lookout at how it's going to look over the next 5 years. And as Dana said, we max out at around 3.3, but we'll have the ability at that point to be higher than that. We've already secured our credit facility, so we have a bank that's extremely excited about partnering with us. Right off the bat, we have a $25 million credit facility with them. LIBOR plus 6.6, pro forma right off the bat is at 4.5. Leverage ratio, we'll get a nosebleed in the beginning at 3.5, so we're not going to get close to that. Amortization is good too, so it's not going to be heavy on our cash flow in the beginning. The most important part with that facility too, we have the ability with them. They're going to be able to syndicate, meaning bring in other investors that they lead to get us to 100 million. I think in our model, we probably put on $60 million in debt over the course of 5 years. We'll have enough dry powder to create value through our debt. So returns analysis, we did 5 years for the assumption, exiting at that $25 million post-corporate at 10, 12, and 14. What we're seeing is, and this is a net, so this is after the carry and everything, for the 3 million, you get a 3.8 MOIC, 32% IRR, at a 12 times, 4.7, 39% IRR, and then at a 14 times, it's a 5.7, 44% IRR. The reason why we'd be able to go up to potentially that 14 times is if we have a really strong pipeline that we have following that. So that's where, that's another thing that we're constantly looking at as we go out to market. Like for instance, with US Endodontics, which I talked about earlier, going to market, I have a full pipeline that we're executing on. And then as we go to market, what the other potential partners will want to invest in as well. And that's where you get a little bit more uplift with the multiple. Want to talk about the balance sheet? There's not much.
Yeah, and then I think, here's just a balance sheet, like Dan was saying, we go up to about 70 million in debt with our debt terms. We have cash flow that goes towards the prepayment of the debt. And so, due to that, we get in that 3 times leverage, which is pretty conservative. So that's all we got.
All right. And the doctors thank you. The doctors that roll in their equity, are they paying carry and et cetera, or they have just straight equity?
Just straight equity.
And if you go back to the pro forma with the number of the years and the number of practices, it's 2021, 8, 13, 19 cumulative practices. Didn't I see we had 21 under an LOI, or was that identified practices? What was that earlier slide?
Yeah, I think earlier that was just the pipeline of opportunities that we've identified.
Oh, yeah.
So how many are any of those under LOI? How many are under?
We have 5 currently to form the platform under LOI. We have a pipeline that we're currently working with, but not until we fund. I'm not going to put anything else under LOI because I want to be able to close within 45 to 60 days.
But you've had discussions with those 20?
Yes. Yep. We've had discussions. If you want to go back to the Arizona the pipeline. So with that, just in Arizona market, we've had discussions with this first group of 40 million in revenue and 8 million in EBITDA, and then Utah, 8 million in revenue, 1.6 million in EBITDA, and then Colorado. So these are various sides. We have not put out LOIs to these groups yet, though, or to these practices.
All right, and then the salaries that they're taking before and after, how big a cut, or are they taking a cut in salaries?
Most likely we'll take some cut. I try to keep it less than 25%. So the way we go through that, it's a valuation analysis that we have to go through each one of these opportunities. So whatever I reset their comp at that 32, 35, 38% of net collections, the way I repair that income from them is the cash that they get at close post-tax. So for instance, if they get if there's $100,000 delta from what they were making without us and what they're making with us, what I like to do is I want to get them at least $500,000 of after-tax cash proceeds in their pocket, because that way they're covered. I de-risk them for 5 years. That's part of my analysis that we do with our M&A team. I have to be able to de-risk this investment for them as well. Our average life is around 5 years in our investments. Could go a little bit longer, could go shorter, but I want to be able to at least de-risk them for 5 years.
And is that a base salary with incentives or just a straight salary? How does that work?
It's based on eat what you kill. So it's a 35% of net collection. So whatever they produce, then we collect, they get paid off of that. So in the month, they'll have the month of February, they'll collect $100,000 as an example. By February 15th, they get paid a percentage of that.
Gotcha. And go ahead.
So they're incentivized again, and it's very common in these models to have it work that way. And what we've seen is, with a lot of our dentist partners, they may have a little bit of a decrease because of the new percentage of net collections, but they also understand their market, they understand their practice, where if they wanted to, they can work a little bit differently and maybe make it up in a short period of time. We don't push them to do that. That's not my incentive with them, but that's sometimes what happens.
Yep. And the doctors you're talking to now, are there any other active groups that they're talking to them at the same time? I mean, is there direct competition at this moment from a similar outfit?
Yeah, there's another group that talked to Dr. Cavendish, for example, and that group's a pretty big group out there called MB2. But MB2, when they put together their valuation, they were going to give him a little bit more money, but his equity wasn't going into the bigger company. It wasn't going into the DSO. It was, you're going to get a piece of your profit sharing at your practice level. So, in all dental organizations that I'm part of, we have competition. A lot of times, though, I like having the comparison, so I can compare what we do and what they do.
And what is the number one selling point that you use? The equity, the difference between you and your competition?
It's the equity, and I think nowadays too, it's are you better off with us or by yourself? And I can do that economically. If I can show them that they're better off with us, fine. But it's really, before the pandemic, they would always say, there's a lot of people that are on the fence, and they would say, I'm fine doing what I'm doing. Pandemic happened, it was a light bulb. My pipeline grew because not everything's always going to stay the same. They wish they had access to the PP&E that I had because of our investments. I was able to get everyone large amounts of PPE before April. We were able to help out with human resources. Unfortunately, non-elective had to shut down. That's hard work to be able to do that as a dentist when you're not trained to do that, to be able to furlough employees and track that with the state. So, a lot of times what we saw with really strong doctors I love to partner with didn't want to make a change, but then during the pandemic, they were calling our partners up to see how it was working with us.
And the typical doctor, if they do this in 5 years, they have the big payoff with the PE firm. What's their game plan then? Take the money and run, or they have to do another non-compete and another contract? How does the PE company know they're not going to bail after their 5 years in your deal?
Yeah, so I mean that's part of our our doctors being the age that they are. So when they get to their second bite of the apple, in order for us to get that valuation, they're going to have to roll in equity and take some cash off the table. If I have all the doctors saying that they're going to take all the cash off the table and run, we're not going to get that valuation. So there just wouldn't be a deal at that point. So during the due diligence, when we get to an exit value, the next private equity group is doing their due diligence, reaching out to, working with our doctors and what their game plan is. Because there are opportunities, or there is situations where we're going to have an older doctor that's going to want to retire. He's done. He wants to retire. And then in some situations, we have younger doctors that are already doing fine financially. They just want to keep on rolling in and creating more equity value for themselves. So it's a little bit of a balance when you have, 100 to 150 doctors, and that's what we've worked with. But, to be clear, if all 150 doctors wanted to totally cash out at the end of 4 or 5 years, we wouldn't have a transaction.
So you target a certain age? Will you target the guy who's 55, 60 years old, or do you stay away from him?
I try not to. The only way, if they're in their 60s, they need to have an associate with them. I got to see some type of, plan for the next doctor to take over, or I have to be able to, confidently try to be able to recruit someone. That was the old way, trying to buy these practices with a doctor who's in his mid to late 60s and saying, hey, I got 2 years to figure this out. 2 years comes really fast. So we don't want it to partner with a lot of practice like that. There's going to be one-offs, but that's not how the business is going to be based on.
Is part of the plan to get kids right out of college and put them in cheap and run them in for 2 or 3 years before they move on? Is that?
No.
Nope.
No, I know our plan is to partner with strong clinicians. So people that have been around, they've been practicing for 10 or 15 years, have a strong base, are good clinically, so we don't have to worry about that aspect of it. And then they want to grow the company. They're being proactive. They don't want to be bought by an MB2 that's only giving them a fraction of their equity or a fraction of a company. So our key candidate is, a doctor that's doing, an office of 1.5 or higher, that's in their mid to late 40s, that understands the equity component and is willing to be there for the next 5 to 10 years.
And there's a question here about hygienists being the biggest revenue drivers. Is that the case? And is that part of the plan, is to bring in more hygienists? And
not necessarily. I mean, it depends on the situation, but they're strong hygiene revenue drivers. What I see as an efficient practice is if I had $1 million in production, 25 to 30% would be hygiene. What we usually see is closer to that 10 to 15% to 20%. It's a large driver to EBITDA if you handle hygiene correctly, because that drops to the bottom line, because your hygienists are paid between $32 to $40 an hour. So that's kind of like their fixed cost working 4 days a week. So if you're able to make them more productive, their 8 hours that they're there, that's where you get the uptick. And you make them more productive a couple of different ways. Part of it, and this is what Mitch and Lamont do, this is how they help increase value for their companies. It's making sure that the hygienist knows that they're just not teeth polishers. They're providers. They have to take a comprehensive look at the mouth, just like a doctor, and make the right recommendation, not based on what they think they know about the patient's financial needs, but what they actually need to be done to their mouth.
All right. And then the capital call schedule, we're paying all up front, right?
Yep, paying all up front. The one, I think we had additional $3 million in capital that we would need over the course of 5 years. And then, so the initial capital call would fund this transaction, and then we would put together a model where we think we would need potentially more capital in year 2 or year 3. But the most we have, and this is as a group that we have planned right now, is an additional $3 million in capital need. But as a Class A investor with us, you have tag along rights and everything else. You're pari passu.
All right. And then what about capital expenditures? I mean, is there any huge upfront or along the way to keep these practices modern with, I don't know, x-ray machines, et cetera?
Sure. Yep. And that's part of, our due diligence. So if we go into a practice and, it's part of that IT, and we see all the servers are from, 2000 and everything's breaking down, that's going to be a purchase price adjustment. So I'm going to take down the purchase price because I have to buy $100,000 worth of computer IT. Same thing, if they don't have an X-ray or they want an X-ray, that's part of the conversation that I'm having with them during due diligence. So post-close, they don't say, hey, Dan, how about that X-ray, after we close. So those are things, I mean, that's part of developing a strong relationship with our partners, that we figure that out. The way we model it, CapEx is around 3% of revenue, so repairs and maintenance, that's part of our cash flow model. So we do have that. And sometimes there's unexpected things that happen, or they do want, a piece of technology because they think it's going to be beneficial. We'll do a return on investment calculation with them. There's not a lot of red tape in the organization. Get it back, and if it makes sense, if it's going to make us more profitable and make the doctor more profitable, we want to do that.
And then the cash flows all go back into the business, so we shouldn't expect anything until it goes full cycle.
Yes, sir. So no no distributions. So it's all put back into the company for acquisitions to continue growing it.
And I guess you're issuing K-1s. Would there be any tax due but no cash flow? Is that a possibility?
Yeah, I mean, for all of our DSOs that I've done since I've been here and opportunities, there's never been any type of gain. There's always been tax losses, and that's because we're acquisitive, we're making acquisitions, there's depreciation, amortization. However, if there are some type of taxable income, the company will make distributions to you guys to pay for that. But I haven't seen that yet. And I can always have an accountant come on to talk more about that because I don't want to pump my coverage to my tax knowledge.
And the organizational expenses, is there a limit to how high there will be, and what are those expenses?
So as an MSO, my goal is to have it 6% of revenue. That's what 6 to 7% is optimal for our management service organization. So that's something that we put into our budget. Sometimes it's a little bit higher in the beginning where it crests around 8 to 9%. That's fine because as we add on acquisitions, that will lower. But part of the reason why we roll up our sleeves operationally, so we really start working with the companies so we don't spend a lot of money bringing on a controller or a treasurer, and it's a 50-50 chance that they make it. So we spend a lot of time in the first year, the first 12 months, building a strong platform and then adding on team members when needed.
And are there any regulatory risks that you're aware of that we should be aware of?
When you're dealing with healthcare, there is, and that's part of why one of our consultants, PYA, they go in and help us with billing and coding. They'll do that analysis. So that's one aspect that we do take into account the risk. We're not doing any Medicaid or very little. It's less than 1%. So I'm not worried about Medicaid issues. It's more insurance, PPO. So that's one part. We do have a compliance program that we put into place. And I think the second part is, once again, kind of table on it, we partner with really strong dental clinicians that are doing the right thing and are not skipping or cutting corners.
There's a question about Smiles Dental. What was the total return and the outcome of that?
Smiles Dental is still ongoing. So that was in 2013. That was a minority investment with us. We partnered with a group called WAFRA. And what happened was their fund stopped, and they introduced a new fund, and they're called Granite Bridge. So for a year, they couldn't make any acquisitions. So the company's doing good. It's about $60 million in revenue, around $10 million in EBITDA. It was supposed to go into a process last year, but COVID happened, so they're waiting until this year. But we had about a 10% investment in that first one. It was one of our major opportunities.
And a couple of questions about the specialty dentistry. What happens when people need that? Do we just refer it out, or would you consider having a couple specialty dentists under this umbrella to send, within the umbrella?
Sure. For the most part, I like our general dentists to really concentrate on crown and bridges and what they're good at and bringing in patient care with hygiene and having the patients come every 6 months. If we do have specialists, I like to have more of a centrally located position where they could come in and I'll have the equipment there for the endodontist or the oral surgeon. But right now our focus is on general dentistry with this group.
And then depreciation, et cetera, it's passed through Parapursue 100%. It's based on our percentage ownership.
I'm sorry, I didn't catch that first part.
Depreciation, it passed through directly in relation to our percentage of ownership.
That's right.
And do you underwrite an increase or decrease in productivity? for the doctors once they come on? And what's your experience? Do they get more productive or stay just as productive?
So more productive, or usually more productive. I don't do a decrease or an increase when they join us. So once again, I don't partner with someone who's doing $1 million and say, I know you're going to do 1.5. That's something I hope to budget for and plan for and work with them, but that's not how we underwrite. I don't also look for a decrease. I'm buying cash flow. So I want them to maintain that cash flow. That's part of our due diligence. One of the ways we do that is making sure that we don't change systems on them. So for the dentists on the phone, they understand in general dentistry, there's two major practice management systems, Dentrix or EagleSoft. When we go in, I don't change that on them. I don't make everyone Dentrix or everyone EagleSoft. I put our practice analytics on top to pull out the data. And by doing that, lessening any type of disruption that they will have with collecting. So prior, 2012 and prior, what you'll see is an acquisition would happen and then there'd be a dip. Everyone would plan for a dip. And that dip would be because you're putting them on Dentrix, you're running parallel systems. I found out that that's just not the right way to do it. Office managers like a system, doctors like a system. I want them to use what they're comfortable with, what they're going to be most productive with. I'll spend the extra money. I'll do the coding in to make sure that they can continue the way they want to.
And there's a question about your specific role in U.S. endo, U.S. oral surgery, and small doctors. Did you do just the fundraising? Did you do the actual management? Did you work with the PE firms? What exactly did Thurston do in those deals? What was their role?
We created each one. So we're the founders of every one of those companies. So we would found the company. If it becomes where we would need more equity and money, we would bring in private equity partners like a Riverglade for U.S. Endo or for U.S. Oral Surgery. U.S. Endo, it's all Thurston Group money. South Georgia's all Thurston Group money. Smile Doctors, we brought in Sheridan Capital, but it was founded by Thurston Group. We were the ones that got the initial platform, LOI. Pat Haynes, my CEO and chairman of Thurston, is the chairman of these companies. We come in some cases, in interim roles, and then the rest of the time we're just partners and helping out day to day when we can, and then part of the board. With Gen 4, we're going to be very involved like we are with US Endo, like US Oral Surgery. In the beginning, specifically the first 12 months, we're really helping set that platform up for success.
And is there any chance that you could combine some of these other outfits you've created already to sell to get more money, or are you going to do them one at a time?
I'm going to do it one at a time. I think there is some potential probably with endo and oral surgery in the future to partner up. But with general dentistry, this is going to be a solo platform. South Georgia and the Southeast is a solo platform. There's value creating this geographic concentration, getting it up to that 25 and post-corporate EBITDA. It's a discipline to it, not wanting to go out and start combining everything, but there's different cultures and different cohesions that we have to pay respect to.
And the branding for all these practices you buy, that they will all be called Gen 4, or will they still be whatever practice?
Yeah, good question. We keep everything the way it is. So whatever it says on the shingle, it stays like that post-close. We don't come in with new scrubs trying to change the way they look. These practices are proud. There's a legacy to them. They're a fabric of their community. The last thing we want to do is change that. I'm investing and partnering with them because of who they are. So we don't change that.
And the last deal you did was in 2018. What has Thurston done in the last 3 years as far as opportunities, and why now versus then?
So we also did U.S. orthopedic surgery last September in 2020. That's an orthopedic surgery group that we partnered with FFL. We created a real estate investment trust in March of 2020. I think we're staying pretty active for a smaller private equity firm, especially with the operational roles that we develop. I mean, going for 2018, 2017 was oral surgery. 2018 was South Georgia and U.S. Endo, and both of them have grown significantly.
And are there any reports that or due diligence you did on these markets that you could share with the group as far as growth, et cetera?
Sure. You can look at we're finishing up the QVs. We're doing our other reports that are part of our due diligence process that we do for all of our deals.
And have multiples compressed in the last, 5-10 years since you started this, or that actually expanded on it? But
I think they've expanded. Maybe during COVID, they started going down, but what I think with my, being in the market and talking to different investment bankers across the U.S., what I think people are seeing is that dental has done really well, even through a pandemic. People liked it after the recession because it bounced back really well. So it took a dip in the recession, but then it bounced back almost 20% higher. Strong market. And now what people are seeing is, yeah, the pandemic closed down offices, but there was pent-up demand. People came back, and in most practices, if we take a look just at, Gen 4 practices, the 5 that we have under LOI, the lowest, one of them went down was 60% for a month period from prior year. And they're all, we're getting the QVs completed, but they're all hitting where they were at the prior year. So there's that pent-up demand. They're able to barrel down and do their job. So to me, that makes, the dental market even stronger than it was before, when you could start thinking about it almost being pandemic proof. You go through this global pandemic and still come close or exceed to what you were the previous year is very strong to me.
And do you stay away from the Medicaid practices? And there's not, a lot of people don't have dental insurance, so it's a cash payment. So are there certain segments of the market that you will go after or stay away from?
Yeah, this is not going to be, there's some plays that are Medicaid. This is not going to be a Medicaid investment. So for Gen 4 specifically, very little Medicaid, 1%. It's not going to grow. I think if you do invest in Medicaid, you got to understand your identity. So if you buy a Medicaid practice, it should stay a Medicaid practice. You shouldn't try to switch it to a fee-for-service or an in-network insurance practice. In our South Georgia location, there is Medicaid. Georgia pays Medicaid within 14 days, and it's just a stronger model there. So, we're able to take a different look depending on the geographic and the strategy. But Gen 4, this is a strategy that we say is not going to be a Medicaid strategy.
And there's a question about the surcharges to compensate for the additional expenses associated with COVID safety, PPE, separate rooms, et cetera. So are there many expenses associated with the COVID, and how's that hurting the bottom line, I guess?
Everyone did have to pay probably, some more money on PP&E, and there was a surcharge that every practice was paying. I think it was like another $10 or $12. Everyone recouped their money on that, so they're no longer doing it. And the reason why, it was a little bit more expensive in the beginning was because there wasn't a lot of supply. So people were doing crazy stuff to buy N95 masks and everything else. So today we just don't see that. And
in closing, can you go over the timing of closing, who people should reach out to, what the minimums are again, and how people should invest?
Yeah, so for this opportunity, we plan on closing this at the end of March. We're pretty much done with our quality of earnings. We had them updated in December. We're doing our legal due diligence now. Working with your group, we were hoping to have, the $3 million investment. In our other deals, our minimum, individual investments around $500,000. But for this opportunity, with the group, we're able to go to that $3 million in aggregate. Did that answer that question?
I mean, what the individual, they can invest at what level?
Individually, for this group, as long as we get to $3 million, I really don't have an issue with minimums. You could be 50 to 100, however you guys want to do it.
Okay. All right. And who's our best contact to reach out to for more information and to invest, et cetera?
Myself and then Dana.
All right. Very good. Well, thank you for your time, and we will share the recording, and I'm sure we'll be in contact in the next couple of weeks to iron out all the details.
Well, thank you very much. Appreciate everyone's time, and hopefully we can work together.
Very good. Thank you, sir. Have a good one. Stay
Thank you.
safe.
Yep. Thanks, everyone.